So we are looking at accounting concepts. So at the end of this lesson, I am hoping that you should be able to know the need for conceptual framework of accounting, understand and describe the generally accepted accounting principle, appreciate the importance and advantages of uniformity in accounting policies and practices. So let's look at an introduction to what accounting concepts and principles are about. Various accounting systems and techniques are designed to meet the needs of the management. The information should be recorded and presented in such a way that management is able to arrive at right conclusions. The ultimate aim of management is to increase profitability and decrease losses. So in order to achieve the objective of the business as a whole, it is important to prepare the accounting statements in accordance with GAAP, that is generally accepted accounting principles. And what is all this about? You know, when we say generally accepted accounting principle, we are saying that the whole world accepts this way of presenting financial statement. It means that no individual organization or country has their own way of preparing financial statements. But worldwide, they have accepted a particular norm that when accountants are preparing financial statements, they have to observe. For instance, you know, when you want to cook, the acceptance norm is that you will need to set the fire, get the dishes and put it on fire and continue from there. If there is no fire, it is impossible for you to prepare a meal. In mathematics, we know that if we said we add, if we see the symbol which is like a cross, it is telling us that we should add. If you see a symbol that is like a dash, it is telling us to take away. If we see a symbol that is like a X, it is telling us to multiply or to find a product. So it means that there is a certain pattern that things are done when it comes to mathematics. The same way in a financial accounting, when statements are prepared, they are not just prepared in a vacuum, but there are laid down rules and procedures by which these statements are prepared. And these laid down procedures and accepted norms are accepted by the whole world. That is why we are regarding it as generally accepted accounting principle. It means that these principles which have been formulated, these procedures which have been formulated by academicians to be used in preparing financial statements have been accepted across the world. So what we are going to look at basically under this topic is to look at what are these principles that have been procedures and concepts that have been developed and have been accepted, and in which way are the things supposed to be done. Those are the concepts that we are going to look at under this topic, so that you know when you are preparing a financial statement, you will be able to know at the end of the period which of the principles, which of the concepts is backing what you are doing. So let's go ahead. So we say we are looking at accounting concepts and principles. So what is accounting concepts all about? We are saying that accounting, what is accounting principles all about? We are saying that accounting principles refers to the rule of action or conduct to be applied in accounting. It may be defined as those rules of conduct or procedure which are adopted by accountants universally, meaning in the whole world, while recording the accounting transactions. So those rules that have been set down, those conduct that have been set down, those procedures, the method that have been formulated and have been accepted throughout the world by accountants in recording transactions, we are referring to this as accounting principles. The accounting principles are classified into two categories. One of the categories is accounting concepts. Then the next category is accounting conventions. So we will take our time to look at what accounting concepts is about and what it entails. Then we'll move on to look at the accounting conventions. At the end of it, that will bring us to the end of this topic. And I hope that we will be able to go through smoothly. So let's look at accounting concepts. Sydney, I cannot see you. Can you start your video so that I see you participating in a class? So accounting concepts are assumptions or postulates which are used in accounting practice and presentation of financial statements. These assumptions are fundamental and must be strictly adhered to in order to present acceptable financial statements. The following are the important accounting concepts to apply in recording and reporting events as well as their respective importance. So when we say accounting concepts, we are saying that they are the practices, they are assumptions, they are guesses. When we say postulates, it's the same as assumptions or guess. It means that these practices have been just guessed. They guess it and it has been accepted. And so anytime accounting statements are supposed to be prepared, these guess, these assumptions, these postulate, this method that have been developed must be followed and they must be adhered to strictly. Not adhering to this means that you are violating the gap that is generally accepted accounting principle and you are not preparing account or financial statement in its accordance. Makati, are you sure you are participating in the class? I see you are too relaxed and I don't like it. Sit up as we continue. So we're looking at examples. So we are looking at types of concepts that we refer to as accounting concepts. One of the concepts is called going concern concept. Going concern concept. What is it about? The going concern concept, we also call it continuity concept. Continuity concept. This concept assumes that business enterprise will continue in operational existence for the unforeseeable future. That is for a long period to exist. Thus, in preparing the financial statement, the accountant assumes that the enterprise is a going concern and it is not likely to be liquidated in the near future. What this means is that because of this concept, so before I explain, let me just conclude. This assumption implies that whilst valuing the assets of the business on the basis of productivity and not on the basis of their realizable value, that is the market value. At market value, you are talking about at cost less depreciation to date for the purpose of balance sheet. It is useful in valuation of assets and liabilities, depreciation of fixed assets, and treatment of prepaid expenses. So what is going concern concept talking about? The going concern concept, which we say is just a guess, is just a procedure that have been formulated and have been accepted, is assuming that no business organization comes into existence that just by 1 year are wind up. by 1 year, I should be closed down. No. Every business organization is established with the mindset that it will carry on until further notice. That one does not know when the business will come to an end. That is continuity. So for this reason, the accountant having this basis in mind, when the accountant is preparing financial statement, he prepared the financial statement bearing in mind that the accounting period will end will continue next financial year. Therefore, when the accountant prepares financial statement, the accountant balances accounts and bring down balances to the beginning of the next period. So when you prepare account, for instance, we have sold goods for 50,000 Ghana cedis cash. Goods sold for 50,000 Ghana cedis cash. That when these accounts are open, we will have to open sales account and open cash account. So we will debit cash account with the description sales with the amount 50,000, whilst we credit sales account with the description cash with the amount 50,000. At the end of the period, we will balance of this account. And let's say if we are preparing the account for May, then at the end of May, we will balance off the account. That is 31st May, balance carried down for cash would have been 50,000. And because the accountant assumes that the business is a going concern and will continue into the future, you balance the account and then carry it down, bring the balance to the other side of the account at the beginning of the next period. So anytime an account is prepared, it is balanced off, and the balance is brought down to the other side of the account, brought down at the beginning of the next period. The concept that is being observed here is going concern concept. Why? Because the assumption is that the business will continue into the next future, unforeseeable future. Therefore, accounts are prepared, their balance is carried down and brought down to the beginning of the next accounting period. So that is going concern concept. The next concept we are going to look at is what we call accrual concept. Accrual concept, which is also called matching concept. Accrual concept, which is also called matching concept. What is accrual concept or matching concept about? The accrual concept states that to measure the profit for a particular period, it is important to match accurately the cost. That is the expenses that is incurred. Whether you have paid for the expense or you have not paid for the expense, with the revenue generated, whether this revenue is received or it has not been received. What this means is that when you sell goods, let's assume that you are an accountant of an organization and you have undertook a transaction. You have incurred an expense by buying some stationeries for office use. And then you paid for some, let's assume you have incurred an expense of 5,000 to buy stationeries for office use. However, you couldn't pay for all. You pay for 3,000 and you have not paid for 2,000. An accrual concept is saying that you have actually incurred the expense of the 5,000, even though you have paid only 3,000 and you are left with 2,000 to pay. Whilst recording, you must record the entire 5,000 because that is the total expense that you have incurred. Let's also assume, and it's also say on the other hand, if you have generated a revenue, for instance, you have sold goods to your clients or customers at 3,000 Ghana cedis, and they have paid you only 2,000 Ghana cedis. It means that you have received 2,000 out of the total revenue, which is 3,000 that you are expected to receive. Accrual concept is saying that the total revenue you have earned for the period is 3,000, not only the cash that you have received. Therefore, when you are recording transactions in the books of account, you are required to record the entire 3,000. That is what the concept it means by saying that to measure profit for a particular period, it is essential to match accurately the cost, that is the expenses incurred, whether you pay for or not, with the revenue generated, whether received or not. Thus, the expenses incurred to ascertain particular revenue should be matched against those revenue they have helped to ascertain. In other words, the accrual concept states that revenue and expenses are recognized and included in the profit and loss account as they are earned or incurred, not when money is received or money paid. I hope you understood what accrual concept is about. Once more to go over it, let's assume that you are expected to pay your school fees, and the school fees bill that your school have given to you to pay is 3,000, or let's say 1,000 Ghana cedis. That is the total expense that you are expected to incur on your school fees. But then whilst you were coming to school or going to school, or when you went to school, you paid only 900 Ghana cedis, remaining, 100 Ghana cedis. Accrual concept is saying that the total expense you are expected to incur in terms of school fees is 1,000 Ghana cedis. Therefore, when recording into the books of account, you must record the expense that you have incurred, 1,000 Ghana cedis. So he's saying that whether you have paid for or not, because you have incurred the expense. So the better example I can also give again is you have gone to buy Gari for school. You bought Gari 2 Olonkas. Each Olonka is 30 cedis. And you bought 2 costing you 60 Ghana cedis. But you have paid 50 Ghana cedis. Accrual concept is saying that the total expense you have incurred is 60 Ghana cedis. Therefore, when recording into the books of account expense incurred, you record 60 Ghana cedis, not the 50 cedis that you have paid, because you certainly will be paying the balance 10 cedis later. So that is about accrual concept, which is also called a matching concept. So at the end of the period, you are expected to compare the total expenses that you have incurred against the total revenue generated or earned. That is when you will be able to know whether you have made profit or you have incurred loss. If the total revenue exceeds the total expenditure or cost you have incurred, then it means that money will be left at hand. Hence, you have earned profit. That is about accrual concept or matching concept. Now we move on to look at the next concept, which is accounting period concept, which is also called periodicity concept. We have what we call accounting period concept or periodicity concept. What is accounting concept? That is the periodicity concept about. This concept says that financial statement of a business can be prepared on the basis of suitable accounting period instead of waiting for a long period. So the concept is saying that you cannot just be running a business in a vacuum. you are just running a business, you do not know when to prepare an account, you just start business, just running business continuously. There is a need for you to pause at a point so that you can measure the performance of the business. Pausing at a point means that you stop, prepare an account to be able to know whether the business that you are running, you are actually running at a loss or you are running at a profit. And the profit that you are generating, is it worth? Are you able to use those revenue generated to pay other expenses and have something left? So pausing here means that you have run a business for a period. So you want to assess the business for that period. And in accounting, the accepted period for a business to pause, to prepare financial statement, to measure its performance is 12 calendar months. So when you are running a business, and then from month 1, if you start business, let's say in June 1, then you are expected that in 12 months' time, that is the following year, May 31st, you are expected to pause and then prepare financial statement. So this period is called in accounting financial period or accounting period or accounting year. And this is the period we are calling periodicity concept or accounting concept. So taking it once more, we are saying that according to the periodicity concept, financial statement of a business cannot be prepared on the basis of suitable, can be prepared on the basis of suitable accounting period instead of waiting for a long period. Being a business in continuous affairs for an indefinite period of time, the proprietors, shareholders, and other users want to know the financial position of the enterprise periodically. Thus, the accounting period is normally adopted for 1 year, that is a 12 calendar month. At the end of each accounting period, an income statement and balance sheet are prepared. This concept is simply intended for periodical ascertainment and reporting the true and fair financial position of business as a whole. So whenever you are preparing an account and you are supposed to prepare an account for a particular period, then there is a concept that is guiding what you are doing. And the concept that guides what you are doing is what you are referring to as periodicity concept or accounting concept. The next concept we want to look at is historical cost concept, or simply cost concept. What is historical concept or cost concept about? This concept implies that assets acquired are recorded in accounting book at the cost or price paid to acquire it. And this cost forms the basis for subsequent accounting for the asset. For accounting purpose, the market value of assets are not taken into account either for valuation or charging depreciation of such assets. The concept has the advantage of bringing objectivity in the preparation and presentation of the financial statement. In the absence of cost concept, figures reported in accounting record will be subjective and questionable. However, due to inflationary tendencies, the preparation of financial statement on the basis of cost concept has become irrelevant for judging the true and fair position of the business. So what is historical cost concept is saying? This concept is saying that when recording assets in a business books, you are expected to record the asset at the cost that the asset has been acquired. If you bought a motor vehicle at the cost of 50,000 Ghana cedis, if you are expected to record in the books of account that cost, which is the 50,000 Ghana cedis. So let's assume 1 year had passed, 2 years has passed, and then 4 years. In a 4th year time, if you still are having that motor vehicle, certainly the value of the motor vehicle in the market may no longer be 50,000, but you cannot change the value of the motor vehicle that you bought 4 years ago, that is selling at 100,000 Ghana cedis today in the market, in the book, that now that same motor vehicle is, the cost is 100,000 Ghana cedis. No. Historical cost concept is saying that when you do that, then you are misrepresenting the financial statement. The reason being that this motor vehicle that you have bought 4 years ago, you have used it over and over again. It has worn out. It has gone under repairs. It has gone under changing of parts. Now, supposing you want to sell that same motor vehicle today, it will even be impossible for you to sell it at the price that you bought it, 50,000. So when recording in the books of account, why recording now at the market value? Are we getting the concept? So cost concept is saying that when an asset is acquired and the business is observing cost concept of recording financial statement, the asset must be recorded at historical cost or at the cost at which it has been bought. Next concept is money measurement concept. Along the way, when you have any question, do not hesitate to raise your hand and you will be allowed to ask your question. Money measurement concept. Money measurement concept is saying that as an accountant, there is no way you will be able to determine a cost and then determine revenue if this is not measurable in figures. You cannot just get up that I have bought machinery and it is not recorded in any figure. I have bought furniture, there is no figure attached. I have bought, I have put up building, there is no cost attached. If there are no figures, how are you going to add? How are you going to subtract? So money measurement concept is saying that accounting transactions are measured, expressed, and recorded in terms of money. This concept excludes those transactions or events which cannot be expressed in terms of money. For instance, factors such as skill of the supervisor, which actually will help in the progress of the business. The product policies, planning, employer-employee relationship cannot be recorded in accounts in spite of their importance to the business. This made the financial statement incomplete. So whenever you are recording transactions in financial account and you are recording them in monetary terms, in terms of money, the concept you are observing while doing that is the money measurement concept. We move on to look at the next concept, which is business entity concept. We also call it separate legal entity concept, or simply entity concept. What does this concept say? The entity concept states that business or company is a body corporate and having a separate legal entity distinct from its proprietors. The proprietors or owners are not liable for the acts of the business. As a separate legal entity, it implies that activities that affect the proprietors, that is the owners, but not the entity, are shown reported on the income statement. For instance, if the proprietor of a business invests 12,000 Ghana cedis in the business, it is deemed that he has given that amount to the business as a loan, which will be shown as a liability for the business. So we can call that equity or capital. On withdrawal of any amount, it will be decided, it will be debited to the proprietor's account and credited to the cash book. So business entity concept is saying that if an individual or groups of people establish business and they cannot distinct their personal transactions from the transactions of a business, then there is a problem. The business may go down soon. Just like what some of you, your relatives does, or your mother, some women do. When money, let's say your father has given money to your mother to transact business while he's away. But whilst your mom was in the market, when Botokwe seller is passing, she bought it. New cloth, she bought it. Funeral time is coming, she bought cloth. She sees a new sandal, wire, she had gone for it. And what is happening is that she is using the business money to incur expenses on herself. In the long run, what will happen is that the money will finish. When the money finished, the business will come to an end. Therefore, it is generally accepted that for business to continue in operational activities, it is prudent for owners of business to separate their personal transactions from activities of the business so that the business can continue to operate or exist into the unforeseeable future. If the owner should take his business money for personal use, he should consider that money as borrowed, and he should be expected to put the money back. This is different from the owner generating revenue and paying salary for himself. But when you put investment in a business and you are taking the business money for personal use, for instance, Ansel, I gave you 100 cedis to sell pure water. Then out of that 100 cedis, you went out today, you took 10 cedis, you ate it. The following day, you took 20 cedis, you ate it. Next day, you took 20. What are you doing to the money? The money will get finished, and you will not be able to sell the pure water at the end of the period. Therefore, for business to continue in operational activities, it is prudent that you observe this concept, that is the separate legal entity concept, so that your personal activities can be separated from business activity. The next is realization concept, which we also call revenue recognition concept. So when does business recognize revenue as earned or generated, so or realized? According to this concept, revenue is realized at the point of sale or transfer of legal ownership rather than just when cash is actually received. Thus, if no sale takes place, no revenue is considered. Revenue is realized when the goods have been passed on to the customer or the buyer, whether cash is received for the goods or not, for the goods sold or not. So when do business recognize revenue as earned? The realization concept is saying that as soon as you have sold a good, recognize that revenue, the cost of the good you have sold or the price of the good you have sold as revenue. For instance, you have come to school and you needed a calculator. You don't have a calculator. I sells calculator. So you have come to me to buy a calculator. And the value of the calculator I sell is 100 Ghana cedis. So, Makati, I sold the calculator to you, but you did not pay for the calculator yet. Realization concept is saying that so far as I have transferred the ownership of the calculator from me. We are saying that the realization concept is saying that so far as I have parted away with the calculator to you, Makati, it means that I am no longer the owner. You now are the owner. Whether you have paid for the calculator 100 cedis or you have not paid for it, so far as I have sold the good, I have transferred ownership to you, I must record that 100 cedis in the books of account as revenue earned, whether you have paid for it or not. Even if you pay part, I will recognize both the part you have paid and the part that is left for you to pay as total revenue earned for the period. That is what realization concept is saying. I'll move on. The next concept is dual aspect concept, which we can also call accounting equivalence concept, dual aspect concept, or accounting equivalence concept. What does this concept say? According to this concept, every business transaction involves two aspects, which are for every receiving benefit and there is a corresponding giving of benefit. The dual aspect is the basis of double entry bookkeeping. Accordingly, for every debit entry, there is an equal and corresponding credit entry. So the double entry system, which says that for every debit entry, there is a corresponding credit entry. So when one account is debiting, the corresponding account must be crediting. The concept that is observed in recording this transaction, in observing the double entry, is what we are calling dual aspect concept or accounting equivalence concept. So whenever you've undertaken a transaction and then you open an account and debit and then open a corresponding account and credit, know that the concept that has backed this procedure you are observing is what we are referring to as dual aspect concept or accounting equivalence concept. The next concept is objectivity concept. Objectivity concept. What is objectivity concept? This concept holds that financial statements should not be influenced by personal bias of management or the one who prepared it. The use of historical costs for asset valuation is an attempt to be objective because it can be backed up or verified by vouchers, invoices, checks, bills, deposit form, receipt, etc. In the absence of this concept, financial statement may be fictitious, or we can say the financial statement is forged by the management in an attempt to misrepresent or to satisfy the financial position and performance. The use of this concept places assurance in the users that the financial reports are free from personal bias and data contained therein are verifiable. So objectivity concept is saying that if an accountant as you are recording financial statement, you should never be influenced by personal judgment nor influenced by any other powerful hands in recording transactions. For instance, if you bought computer for office use and the value of the computer is 100 Ghana cedis, record 100 Ghana cedis. Even if management says that make it 150, do not make it 150. By making it 150, it means that you are not objective, you are biased. The financial statement you have presented did not represent the true and fair nature of the transactions that have taken place. Per the example I have given in the explanation, we are saying that if financial statement is said to be objective, then we are saying that you bought motor vehicle at 20,000 Ghana cedis 5 years ago. Today, the motor vehicle market value is 70,000 Ghana cedis. You cannot go and record 70,000 Ghana cedis in the books as the value of the asset. When that happened, where the difference, did you actually spend it? You paid 50,000, 20,000. Then 5 years ago, today you are recording 70,000 because that is how much the vehicle now costs in the market. The difference, did you actually pay it? You didn't. You only recorded because that is the new value in the market. So where has that money gone to? It might have gone into somebody's pocket. If not the accountant's pocket, it has gone into management's pocket. Then what happens is that then you are being influenced. The financial statement would have been biased. But when you observe the historical costs in recording transaction, you can prove it. You can pick a receipt of the motor vehicle you actually bought. That, hey, I bought it 20 cedis. Here is the receipt. I bought it 20 cedis. Here is the check. I bought it 20 cedis. Here is the bill. I bought it 20 cedis. Here is the deposit slip or the deposit form. When that happens, then we are saying that the financial statement prepared is objective. Objective means that it is true and fair. It is not the statement is not misrepresenting. That is the accurate financial statement you have prepared. So that is objectivity concept. So when you prepare financial statement, that is not influenced by anything, but you record transactions as they are, incur revenue as they have been earned. Then what you are observing is that you are observing the objectivity concept in recording transaction. Anything apart from that means that the financial statement is subjective. So those are the accounting concepts that we have looked at. So if you can remember, going back, we have said that accounting principles are grouped into two. We say one is accounting concepts and accounting conventions. We have tried to look at what accounting concepts are, and we have looked at examples of concepts that are regarded as accounting concepts. We look at going concern concept, we look at accrual concept, we have looked at accounting period concept, we have looked at historical cost concept, we have gone ahead to look at money measurement concept, and then we have looked at business entity concept, hence looking at realization cost concept, and then dual aspect concept, and finally we have looked at objectivity concept. Now we look at the second type of principles in accounting, that is accounting conventions. Accounting conventions. What are accounting conventions? One, we have accounting conventions are those customs or methods or practices to be followed as a guideline for the preparation of a financial statement. This concept is based on what is practicable and is subject to change as new developments arise. So we are saying that accounting conventions, they are methods that have been laid down. For instance, if you are asked to prepare cash account, the method for preparing cash account is that you must open an account which is in a T form, having a debit side and having a credit side. It is a method that is developed. So that will guide you whenever you are preparing an account. When you are preparing a balance sheet, there are methods, there are customs, there are practices that have been developed, which are followed. We have the horizontal method, which is like T account, that capital and liabilities will show at one side, and then the assets, both current and non-current, will show at one side. Or you use the vertical method that will show everything on one page, bringing assets first, followed by liabilities, that is long-term and current, and then the owner's equity. Those are methods developed, and we call this method and practices which are followed in preparing financial statements as conventions. And we are saying that the conventions are proof for change. If in the future it is realized that there is a better modified way of presenting the financial preparing balance sheet than the way it is currently done, then it could be subject to review. That it's expected to be, once it is generally accepted in the whole world as a practice, then every country, every business organization will now adopt that for use. Previously, balance sheet preparation was horizontal method, which was T account. As the practice continues, it was new method was found. That was the vertical method, which is now most appropriate for use in preparing balance sheet. If in the future a new method has become across, it could be reviewed, which is better off. Using it is better than, will add value to the preparation of the account than the previous one. It could be adopted and is used. And these are what we are calling accounting conventions. What are some of the conventions or practices or methods that we can assume as conventions? One, we call it consistency or comparability. Consistency or comparability. What this concept basically is talking about is that if you are using one method in preparing an account, it is advisable to hold on to that method from one accounting period to the other. When you do that, it becomes easy for you when you want to compare financial statements of the previous financial year with the current one. But where a new method is better off than the previous one, previous year you have used method A in preparing financial statement. Then in the current year, you have changed that method to a new one. What will happen is that when you want to compare the previous financial statement with the current one, it will become difficult. Why? Because the method you are using now is different from the method you used previously. So comparability becomes difficult for you. And this concept is saying that, yes, you are allowed to change method in preparing financial statement. Only and only if you think that the new method you want to use is more useful, is more acceptable, will enhance the financial statement better than the previous one, then you can go ahead and change. Aside that, you are advised to be consistent in the preparation, in using one particular method in preparing your financial statement. If I should take your mind to mathematics, let's say simultaneous equation. Let's assume a question is given to you on simultaneous equation. And we know we have two different methods that can be used to resolve simultaneous equation. We have the elimination method and we have the substitution method. Should one student use elimination method and another use substitution method, you can see that though they will all arrive at the same answer, But it will become difficult if the two students want to make comparison of the method, the procedure, the step they have followed. You can see that. So since they have used different methods, comparability becomes very difficult. So that is what accounting concept, consistency concept is talking about. So let's look at what is it. The convention concept or the convention of consistency states that accounting policies, procedures, and method should remain unchanged for preparation of financial statement from one period to another in order to measure the operation efficiency of a business. These conventions allow meaningful comparison in the performance of different periods. However, alternative improved methods are also equally acceptable if the business will wish to change its method of reporting financial information. So basically, that is what consistency convention is about. The next convention, accounting convention we want to look at is Prudence Convention, which we also call conservatism or prudence. Conservatism or prudence. What does it say? Prudence says that profit should not be anticipated, but all losses should be provided for. That is, this convention emphasizes that uncertainties and risks inherent in business transactions should be given proper considerations and unless an income is known with certainty to be received, it should not be reported on. What is it about? And what is this Prudence Convention saying? Prudence is saying that it will be wrong for a financial accountant, for any business organization or businesswoman or man. Say today you have carried 10 crates of tomatoes. You are taking them to the market to go and sell. One of the crates of tomatoes is 100 Ghana cedis. What it means is that if you sell the 10 tomatoes, then you are earning 1,000 Ghana cedis at the end of the period. But you are just carrying these 10 crates of tomatoes to the market. You have not yet sold them. So it will be wrong for you to just immediately record in the books of accounts that you have earned revenue of 1,000 Ghana cedis. If you do that, what happens? On the way to the market, there was an accident, and all the tomatoes got damaged. Did you realize what you have done to the books? You have recorded 1,000 cedis as earned. Meanwhile, you have not yet sold the goods where you can determine revenue as realized. So what Prudence is saying that unless you are sure that this revenue is actually earned, then record it in the book. But however, you should be prudent enough to envisage circumstances that are inherent in a business, failures that are ahead of you, so far as you are doing this business. So Prudence is saying that whilst you are in business, anticipate losses. And those losses that you have anticipated, make provision for them and actually record them that you have incurred them, but not revenue. So for instance, the tomatoes scenario I have given, Prudence is saying that assume that since tomatoes is a perishable good, assume that some will certainly get spoiled. So you assume that, okay, I have 10 crates of tomatoes, healthy tomatoes that I am taking to market to go and sell. One of the crates costs 100 Ghana cedis. It means that at the end of the day,
if I am able to sell all of them, I'll be making 1,000 Ghana cedis. But however, do not assume that you get those monies. Since tomatoes is a perishable good, assume that in the process of packing them into the vehicle and getting it to the market, some will get damaged, some will get broken. So it is possible that you may not be able to sell it at 100 Ghana cedis as it may be and earn the 1,000 when you are able to sell all the 10. So assume an amount. So let's assume that out of the 10 crates that I'm going to sell, maybe I may, if all things be equal, I may lose 50 Ghana cedis worth of it. Maybe they may get broken along the way, or some individual might come and buy and I will use some to add to them. So that amount that you'll be losing, you assume it and record it in the book as an expense, rather than recording profit as well, realized. You have bought a motor vehicle. Assume that by the end of the year, the motor vehicle is being used. I might incur some expenditure on it by repairs. Assume that by the end of the period, if I want to sell this motor vehicle at the end of 1 year, if I bought it at 30,000, I may not be able to sell it at 30,000 because of wear and tear, because the motor vehicle have been used over time. Maybe I bought it 30,000 at the end of 1 year. If I want to sell it, maybe I might lose 10,000 Ghana cedis. I'll sell it at 20, meaning that you are assuming that you are making a loss on the motor vehicle at 10,000. We call that loss on the motor vehicle depreciation and actually record it in the books as an expense. That is what Prudence is saying. Prudence is saying that when you have taken the step to sell goods to your customers on credit, don't not think that all your customers will come and pay your money, or you will be able to recoup all the monies that you're supposed to earn because of the credit sales. Assume that there might be some debts that may be considered as bad. What do we mean by that? Meaning that there might be some customers that may run away with your money. There might be some customers that will insist that they have paid, meanwhile they have not paid you. There might be some customers that may die, and so you will not be able to recoup the money. There might be some customers that might have gone bankrupt, and so they will not be able to pay you your money. So you must make provision for those losses and record it actually in the book that you have incurred those expenses. Whilst you are doing so, what you are observing is prudence concept. That is what prudence is talking about. The next convention is materiality. 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 What does materiality say? It says that consideration should be given to all material events. Insignificant details are ignored while preparing the financial statement. Thus, the preparation of accounts involves a high degree of judgment. By this, the accountant should attach importance to material details and ignore insignificant details. The evaluation of materials or important immaterial depend on the circumstances and lies at the discretion of the accountant. So what do we mean by material or materiality? Let's say a charcoal seller by the roadside who sells a bag of charcoal at 25 Ghana cedis. And I've taken 5 bags of charcoal to the market. If she's able to sell all, she will be earning revenue of 125 Ghana cedis when she sells all. In the market, after selling at the end of the day, she had lost 50 Ghana cedis. She searched through the purse. She does not know how the money have gotten missing out of the 125 good that she has sold at the end of the day. So she had lost 50 Ghana cedi after selling the 5 charcoal. Let's put that scenario at a side. Let's also take Sonrise Christian High School as an example. At the end of the period, all students have paid their school fees, and Sonrise have lost 25 Ghana cedis. These two scenarios that I've given, who will feel the pain the more? Can you give me an answer? If you are ready, you raise your hand, unmute yourself, and give me an answer. Sonrise losing 25 Ghana cedis. A charcoal seller who sells 5 bags of charcoal also loses 25 Ghana cedis. Which of these individuals will feel the pain? Yes.
Say the charcoal seller. The charcoal seller.
The charcoal seller.
Yeah.
Good. So you can see that the money that is missing to the charcoal seller is material. So she has to record it as money lost. But to Sonrise will not feel the pain. Let's say we have 200 students who come to school, and you are all paying 1,000 Ghana cedis. Let's assume. And they lose 25. You have all the 200 students have paid in full 1,000 cedis each, and the school is losing 25 Ghana cedis. Oh, it will not feel the pain. They will not even consider it that money has been missing. So financial record is saying that you should record transactions that are material. If something is immaterial, it will become insignificant for you to record it in the books of account. Do you get what I'm saying? Another scenario I want to give is that let's assume there is a customer of a business A who is owing a business A, and for a long period of time refusing to pay the money. So business A is taking a step to take the customer to court. However, the amount that business A is going to spend before retrieving the debt is higher than the debt which is actually owed the business A. Then it will be foolishness to chase that money. Because if you can spend more to take the money, then it is better you ignore the money. That becomes immaterial. So materiality simply is saying that it depends on the judgment of the accountant and the particular organization that is involved. Transactions which are material should be recorded, but immaterial events should be ignored. The next is full disclosure. Full disclosure. Full disclosure. What does full disclosure talk about? The full disclosure says that all material information is one of the important accounting convention. The disclosure of all material information is an important aspect of accounting convention. According to this convention, all accounting statements should be honestly prepared, and all facts and figures significant to the users must fully be disclosed therein or in a footnote to such statement. The disclosure of the financial information is required for different parties who are interested in the welfare of the enterprise or the organization in evaluating the performance of the firm. The company law lay down the form, that is the content of the profit, and then the loss account and the balance sheet to ensure that information about material event is not withheld. So full disclosure convention is saying that every significant information that is necessary in the preparation of the account must be disclosed. All necessary information that are significant to the preparation of the account must be disclosed. For instance, if you have prepared an account, say you have electricity bill, which is costing out 25,000 at the end of the year. If somebody look at it, the person may raise the may sigh or may be amazed. 25 cities comparing the revenue that the enterprise is making. Whilst you are preparing the account, it is relevant for you to maybe add additional information. What make up the 25 cities? Maybe a footnote should be disclosing that the 25,000 Ghana cedis include so and so amount each per month of 12-month period or 5-month period, so that when they look at, when auditors or the users want to verify if this is true, they take the receipts, or that is the source document, they can be able to verify what make up that amount. Every necessary information that concerns a transaction should be fully disclosed in the financial statement. We also have what we call substance over form. Substance over form. According to this convention or concept, business transactions are usually governed by legal principles. Nevertheless, they are accounted for and presented in accordance with their financial substance and economic reality, and not merely by their legal form. This concept is one of the key determinants of reliable information. So we are saying that if the transaction is of economic significance, it should be recorded. If not, it should be ignored. So these are the conventions of accounting. So we have accounting concepts and accounting conventions. And we have looked at the examples of accounting concepts, where we went ahead to look at accounting conventions. These are two separate things. Some are concepts, some are conventions. However, there are some resource books which combine all of them as concepts. Even when you look at your examination questions, past questions, you will see that some of these conventions, while the questions was asked to state and explain some number of accounting concepts, you will see that in the answers provided, you see some conventions that are included in the concepts as well. So it is important for you to know the categories. The examination questions, some have been mixed up, but the important thing for you is to be able to know that they are of different categories. So when you are preparing a financial statement, you should be able to know this record that I'm taking, which of these concepts is governing it? Which of these concepts am I observing? Which of these conventions am I observing whilst recording this particular transaction? However, all these important concepts and conventions that we have looked at, they also have their limitations or disadvantages. What are the limitations? One, some of the concepts may lose their relevance due to loss of time. We are saying that some of the concepts and conventions that have been developed, because now we are in a modern era, new things are being developed now and then, some of the concepts may lose their relevance. Two, application of alternative methods lack uniformity in financial statements and make comparison difficult. Because there are different methods that are available for us to use in preparing financial statements, it makes it difficult for comparison to be done. Answer, why have you muted your video? I want to assume that you are doing something at the background you don't want me to see. That is why. So please, I want to see you. The next is that accounting considers only those transactions which can be measured in monetary terms. So if any transaction which cannot be quantified in monetary terms, we don't record it. Accounting is only historical in nature. It does not report on present value. Accounting provides limited information to management. Limited information because the accounting information will only give transactions that are measurable in monetary terms. But other information on better customer-client relationship, employer-employee relationship, and then supervisor-employee relationships and others, quality of management and quality of employees, accounting record does not consider that. So limited informations are provided. And then the choice of method for reporting of financial statement may be subjective. That is, may be influenced by personal view or the one who is preparing it, thereby reducing objectivity. So basically, these are the limitations of accounting concepts and conventions. And I have some questions here, but before we look at those questions, which will be there for you to go and try your hand on, these bring us to the end of our presentation and the topic accounting concepts and conventions. If you have any question, you have the time now to ask so that all of us will help address the question. Any question, class? Answer? Jennifer? Sydney? You don't have question for me. Then should I assume that you have understood very well what accounting concepts and principles is about? If I should assume so, then here are some few questions. What are accounting concepts? By now, you should be able to define and explain what accounting concepts are about. State the accounting concepts or conventions which best explain each of the following statements. It means that there is a statement that is given. You should be able to give me a convention or a concept that represents this. So let's forget about question 1A, because we have just gone through it. I assume that you will not be able to actually get it off head. So, but you will help me answer B part of the question. The question says, state the accounting concept or convention which best explain each of the following statements. So 1, unless there is an evidence to the contrary, accounting assumes that a business will operate into the foreseeable future. Which concepts back this statement, or does this statement represent? Class, I need your response. Which statement, which concept explain this transaction, this statement, this sentence?
Sir, should we answer?
Yes, I am expecting an answer from you. So if you are ready with your answer, raise your hand, unmute yourself, and give me the answer.
Sir, going.
Jennifer, I can't hear you. I didn't hear you, Jennifer. Come again.
Sir, going concern concept.
Beautiful. Going concern concept. Going concern concept. That is very true. What is another name we can give if you do not want to write going concern concept? What can you also write? What is another name for going concern concept?
Continuity.
Continuity concept. Continuity concept. That is correct. Now let's look at 2. Revenue and expenses are recognized as they are earned or incurred and not when money is received or paid. Revenue and expenses are recognized as they are earned or incurred and not when money is received or paid. Yes, Sydney? Sydney, go ahead.
Accruable concept.
Come again.
Accruable concept.
I cannot hear you. There is nothing like accruable concept. We don't have any concept called accruable concept. So can you come again? We don't have any concept called accruable concept. So I assume that is not the answer. Yes, I am listening. Revenue and expenses are recognized as they are earned or incurred and not when money is received or paid. Nobody? So, Sydney, you say accruable concept, which is actually accrual concept. What does it say? So the answer to this question is realization concept. Realization concept. Realization concept. Realization concept says revenue is expected to be earned when money has exchanged hand. Is my answer correct or not? Is my answer correct? That's what I am saying. Are you sure it's correct? Are you sure the answer I've given you?
Yes, it's correct. And it's also called revenue. Yes, it's correct.
So if we find another answer which represents this, no, hold on. I won't tell you whether it is correct or I am wrong. We will go back to the concept. We will go back to see if what Sydney was saying is the right answer or what I said is the right answer. So I could say the wrong answer, teasing you to prove your stand to me whether you actually are right or not. So the next question, the accounting treatment of like items should be continuously applied from one accounting period to the next. Which concept does this represent? The accounting treatment of like items should be continuously applied from one accounting period to another. Which concept or convention does this statement represent? When I asked you to ask questions, you were quiet, which proved to me that you actually understood everything. But here I am asking you questions, it's difficult for you to interact. Yes, Sydney, did I see you unmute yourself? This is consistency.
Yes.
Consistency.
Periodicity.
No.
Periodicity.
This is not periodicity. They are saying the accounting treatment of like items should be continually applied from one accounting period to another. So we are saying that, what do we call it? The same method should be applied over and over again. So it's different from pausing and preparing an account at the end of the period. Next, we have a business should not lay claim to profit before they have been earned with reasonable certainty, but should anticipate future losses. Yes. Question 4. Question 4. A business should not lay claim to profit before they are earned. But the business should go ahead and anticipate losses and record them as such. This is prudence. 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 I've just explained prudence, saying that unless you are sure that revenue is earned, you should not be in right. Where I use tomatoes as an example. You are going to sell and then 10 baskets of tomato, 100 cedi, then quickly you record that you are going to earn 1,000 cedi. He said, no, do not do so, but rather anticipate the circumstances inherent with the selling of the tomato, the dangers involved, and assume a loss that you incur and record them. That is prudence. An accounting statement should not be influenced by a personal bias of a person preparing it. Yes? The answer to this question is objectivity. Objectivity. It says it should be objective and be true and fair in the representation of your financial statement. But your preparation of the financial statement should not be influenced by your personal judgment nor management. Next, the assumption that for reporting purposes, the life of an enterprise can be divided discrete time period. The assumption that for reporting purposes, the life of an enterprise can be divided discrete time period. Yes. This is periodicity, which you were given to item 3. So accounting, they are saying that the assumption that for reporting purposes, the life of an enterprise, the financial year of an enterprise should be divided into a discrete time period. And the financial year of an enterprise is 12 months. One financial year, 12 months. That is periodicity. Can you see now? So you cannot use item 3 and say that because they have used in a sentence accounting period to the next one, then you are assuming that periodicity. But this one, they are saying that item 3 says that accounting treatment of like item should be continuously applied. It means that you should be consistent. Continuous, it means that it should be repetitive, consistent with what you are doing over from one period to another. Apply the same thing, apply the same method. That is consistency. But the last one here is talking about periodicity concept. So this is question 1. We have done justice 2. So it means that you have chances to be a lot of questions. You should be able to read and quickly conclude that this is the convention or concept that this sentence is representing. And this is a full WASI question. A full WASI question which will give you 15 marks. So let's say B, how many sentences, statements are there? We are 1, 2, 3, 4, 5, 6. A will take 3 marks, and the rest will take 12 marks. So 6 divided by the remaining 12, it means that the answer you give here, each of them will take 2 marks. 2 marks times 6 will give you 6 marks. Adding to 3, that will give you 15 marks. This is a full set question for WAEC. You're able to answer this, which we even did less than 3 minutes. You have your 15 marks. Question 2 is there. Accounting concepts are the broad basis assumption underlying the preparation of financial statement of a business organization. You are expected to explain the following concept: money measurement, periodicity, consistency, and matching. This is SSC 2000 question. Question 3, you have to distinguish between the following concept: prudence and materiality, realization and accrual, business entity and going concern. And this is a 2003 NOVDEC question. This question will be available on a Google Classroom page. I will upload the slide right after we have ended the class. So you can go and meet it there and go through. And then do those assignments. So exercise 2 and exercise 3 is an assignment for you I will upload it on the Google Classroom page. Please go there and access it, work it, Friday, submit it to me on the page. Submit it on the page. And actually type your answers. This is not a calculation work. Type your answers in words and upload on the page for me to assess them. This assignment 2 I'm giving you, the previous one you have refused to work on it and submit. I am giving you another one. If you are unable to do this and submit again, then I will be tempted to report to your parents your attitude. Aside that, I thank you for your time and your patience. This brings us to the end of the discussion on accounting concepts and principles. Thank you for your time and cooperation. I'll meet you next week by this time. Have a nice day.